All right, Dave, what a man to talk to with the big question being David Keller. After this turbulent period that we just went through where we bottomed and the VIX went to 60, is this going to be a failing rally or are we just going to blow to new highs and the buy the dip people are right again?
Hey, starting with a hard question, Dale. I appreciate it.
Yeah, it's
Um,
the
it
most important question right now, isn't it?
no, it is for sure. And I mean, there's some really interesting push and pull vibes happening in the market right now.
Yeah.
Obviously a nice, upside swing, it feels like right after the CPI number this morning. You had a nice reaction to the PPI number yesterday, jobs number last week. I mean, the market is popping. It
Yeah.
certainly seems like in reaction to economic data that implies that the Fed is sort of in the right place at the right time. The seasonality, and I would argue market history would argue against those things, which is if you're betting on the Fed to kind of get this perfectly right, that's actually an incredibly rare occurrence if you go back through market history. It's
Right.
usually too early, too late, and people can be a lot, very critical down the road about how they navigated a particular period.
Yeah, I
And
mean,
this
unless we put Scully at the controls, no one's going to land that plane on the Hudson.
it's highly unlikely, right? So what that tells me is if they do kind of quote unquote get it right, you just have to be prepared for excessive volatility, which is certainly what, any measure I've looked at certainly tells
Okay,
you
I
what
want
we've
I,
experienced.
I want to ask you, for a long time, people have been saying to me, Dale, the VIX is broke. The VIX is broken. That's because it never went anywhere. So, that's why they thought it was broken. After what it did in one day, and then give it back in 24 hours, now I admit the VIX is broken. And it most likely was broken because people have been selling volatility forever. I mean, that's one of the reasons why I bought VIX calls. But they did not even, they just stopped trading them.
Yeah.
The calls, it's a rigged game. I was long the 20s, December's,
Oof.
and they didn't put any intrinsic value into them at all.
Yeah.
But more than that, just the fact that the VIX could do that in a 24-hour period. I know there were ETFs that were executing volatility selling programs. So
Yeah.
there's got to be, I don't know, some damage unless they just all went on strike and didn't trade it and didn't have to take their losses. Do you
So
know what happened there?
so what concerns me, Dale, is that, and I'm not an options trader. I don't trade options in my own account, but I've
Yeah.
spent the last, year talking with a bunch of options traders, longtime options trader who I feel like people that should know the structure of the VIX and what's happened should know. And I would say there's still plenty of confusion and lack of clarity in terms of what has happened. I mean, certainly the growth and the dominance now of zero DTE options has changed the dynamic of the options market. I think that's undeniable. Things like the put call ratio don't look and behave like I think they have in previous cycles. And I think we
Okay.
might be seeing that with the VIX too. I mean, the reality, I mean, as a technical analyst, you're basically a market historian and you're comparing what you see now versus what you've seen before. And that's one of the benefits of doing this for a couple of years is you've started to see bull and bear cycles and you know how different indicators behave in different phases. And what I would tell you as a market historian is if the VIX spiked up above 65, which it did, and this is all the correction we have, and the bottom is now in, that would literally be the first time in the history of the VIX that that has happened, where we've gotten above 40, above 50, to these levels, and it's not been a much more painful correction in terms of price and usually time as well. So
Interesting.
I hesitate to say this time is different because as a technical analyst, you learned that's usually a bad thing to say because usually the market rhymes with previous cycles. And that for me, I mean, I think just the excessive volatility certainly feels to me like we're in a correction that's probably not done yet. But I think the
Okay.
structural changes are profound and probably a lot more than a lot of us want to assume. So I mean, I've started to honestly try to discount mentally what I'm seeing with the VIX, what I'm seeing with put call ratios, because I think the spike in the VIX is one thing, but the fact that the VIX remains so low, through the beginning of 2024, I think is part of that too. And times when it felt like volatility was excessive, but the VIX was low. And I always joke, my wife is a big fan of the weather and, like Weather Channel type of stuff. And she
Yeah,
would always be interested in the feels like number, right? So the temperature's, 40, but it feels like 25
yeah,
because of the wind chill or something like that. And I feel like the VIX was low teens, feels like 30s at times, sort of like the actual experience was way higher. And it's just one of those real upside down readings I feel like we've had here in 2024, and there have been others too.
yeah, because 5% pullback in the S&P has never sparked this type of move before.
That's exactly
Uh,
right. And
yeah,
so again, as a historian, I think, all right, huge spike in the VIX most likely means if you have any sort of rally, that's probably a counter trend rally, which again, what we have to remember is in bear phases, even short-term bear phases, the biggest up days you will find are
our bear
always in bear
markets.
markets, right? You think that would
Yeah,
be in a bull market that you'd have these big up days. It's usually counter trend swings in a bear market when you see the biggest up days and the biggest upswing. So the fact that we're getting violent upswings right now doesn't surprise me, even if a correction is still happening.
yeah.
This is actually pretty normal for a pullback that you would have these big spikes higher. So again, I mean the volatility feels pretty real to me. But again, as a historian, it feels like there's probably more to come.
I recall putting out a tweet before the top where I'm saying that the board looked strange to me, Dave. I mean, there was actually delays between trades, even in the uh, most liquid instruments like S&Ps. It's almost like
Mm,
they were trading like um, maybe an aftermarket during market hours. A
mm,
quiet board with time lags between trades. Do we have a liquidity issue
yeah.
here in the market?
I mean, it certainly feels like it, right? And I think there are structural challenges. There are a lot of times with new products. I mean, if you look back in history, not just new options and everything, but go back to ETFs, go back to decimalization, go back to sort of those big structural changes, those bullet points you'd think about over your career.
Yeah,
There have always been unintended consequences, right? So ETFs become incredibly widespread. But then all of a sudden, there's this concentration of capital in huge names. I don't think those two things are independent. I think those are related in some ways. And so when, big names change and you need to be weighted to a benchmark and there's a top heavy concentration, it magnifies moves that probably were less magnified before. And so I think you're definitely seeing that with the options market. And again, I think the ripple effects are often really hard to predict. For me, I kind of go back to, I guess, the security blanket approach of just focusing on price and trend. Because the good news is those derivative indicators, like looking at volatility, looking at sentiment, are certainly imperfect in a lot of ways. But trend and price certainly seems to continue to be pretty valuable. And the reason why I think that's the case is you have a lot of algorithms that are out there. You have a lot of automated trading programs, but in a lot of ways they tend to magnify investor behavior. I would argue, right? They just tend to magnify things that would naturally be happening when we naturally overreact to everything as human beings. So I think that price still matters, and so analyzing price is probably the way to go here.
okay. So what are you implying by showing the similarities between April and August here?
Yeah, and
The red
and don't
lines.
and don't assume I'm that bullish because that's what I feel like this chart probably implies. The reason why I think this is important is, I feel like a lot of times during a corrective move, which I think we're certainly in, right? And whether that's over or not is certainly the question I think we'll be answering here over the next week or two.
Yeah,
But I would say that remember that when a market is going down, which the S&P certainly is, I would say the primary trend in the S&P is now lower from mid-July to now mid-August. The question is, how do you know whether this was a buyable dip, whether that early August low was the low, or whether it was just a low, during a
Yeah.
much longer downtrend? And I think part of that is you can try to anticipate it, right? Look for signs of exhaustion, look for signs of things being oversold, look for signs of divergences. And we saw a little bit of that, but not a ton yet, to be honest with you. The other way you do it is you sit on your hands a bit. You're patient and you wait for the market to tell you that the correction is no longer in play. And I think if you look back to, November of last year, which was
Okay.
coming out of the
Yeah.
October low, you look at May of this year coming out of the April low, three things happened in both of those cases. Number one, if you draw a simple trend line, tracking the pullback, we broke above that trend line. Right around that same time, we broke back above the 50-day moving average. Right around that same time, we started making higher highs and higher lows, which tells you we're in a period of accumulation and people are once again buying on dips as opposed to selling, which is why you have this pattern of lower lows in all three of those. So those three things have not happened just yet, but I think there were clear exit signals from those corrective moves that if you're not sort of buying back into the rally by that point, you probably need to be thinking more on the long side than the short side because that's just the sort of primary trend I think at that point. So I think there are three things I'm looking for this week, and maybe we get that with a pop related to the CPI this morning. But I would say until and unless we get above the trend line using the July and early August highs, we get above the 50-day moving average, we start making a higher high and higher low. For me, it's still a corrective move, and you have to think of it that way. So I heard you mention you're sort of, thinking on the short side going into today. I don't have a problem with that because you're basically selling into this
Yeah.
resistance, this what we call a confluence of resistance, and betting on a bit of a snapback, continuing that primary trend. I don't have a problem taking that sort of bet on the tactical time frame and assuming that that continues, and then the market's going to give you a clear signal if you're wrong, and then you adapt.
Yeah. Okay. Where does the red line come in? Around 5,500,
Yeah, well,
54?
it depends on how quick it is, right? So, I mean, if we would pop there today, yeah, it's around 50, we'll say 54.70, 54.80 would be about where we're at today.
Okay.
The longer you wait, obviously the slope is
Yeah.
the slope is going down here. So, I think the question is, do we get above that sort of range? And then at some point we will pull back. You always have pullbacks even in uptrends. And the question is, do we make a higher low? I think that if you're looking for the really buyable point, it's when we start making that next higher low, which tells you and confirms to you, okay, now we're in a period of accumulation. People are buying dips again, like we remember them doing for a lot of the last couple of years, and things are getting back to sort of that normal bull phase. Right.
Okay.
The other thing that we haven't talked about is just the seasonality. Again, if the peak was in July and if we had a strong August and a strong September, I can't tell you how incredibly unusual that would be. I mean, it's possible, but incredibly unlikely. Much more likely scenario is that you have a pretty weak August and a pretty weak September. And most of the time, major peaks have happened in sort of the July, early August timeframe. Here, there's a seasonality tool that I like to show. This is just looking at, it probably makes sense to start at the 2009 low. So we're going 2010 to 2023. This is the S&P 500, just looking at the seasonal tendency. So the number gives you the batting average, what percent of the time it's an up month. And then in the bottom, it's the average returns for each month. And you can see that the weakest 2 month period of all of them is August and September at about a coin flip 50-50 and average negative returns. These are two of the 3 months that have an average negative return. Then if you look at October and if you look at November and if you look at December, this is why you often have a Q4 rally. It's very, very common. That's why it feels like that always happens because it actually almost always does, particularly November. So you often have sort of that seasonal weakness coming out of the summer. You have a strong, some sort of major low and then a strong rally. So we could rally here and have a strong August, but it would actually be incredibly uncommon. And so I've learned not to bet on uncommon things too much because it's highly unlikely that that's going to be the reality.
That's interesting. And July, being the most bullish month, was only bullish for half a month because if you didn't take it, it really wasn't that bullish. In fact, I think the Nasdaq closed lower in the month.
I was going to say July ended up being slightly negative, right? I mean, or very,
Okay.
very close to it, right? It depends on where you start the clock, but
Could you
at best, it
glean
was a flat
anything
month.
into that about market month when the market should have had its best performance, ended up not having good performance, which might be kind of a tell for what's coming?
I mean, if I would tell you this, right? I mean, if you look, this is a weekly chart going back for the last 7 years. If you look at
Yeah,
the average year, I mean, if you look at just pick a random year, you had a
yeah,
major peak in July or August. June is usually a little early, but if you
yeah,
look at July or August, there's always been a major peak. Sometimes not a huge peak, right? Sometimes like
yeah,
2019, where it was a brief pullback to the
right.
200-day moving average before we continued. But most of the major, I mean, anytime we had a significant drawdown, there was that big high in July into August, August 22, July 23, and I would say July 24 certainly lines up pretty well with that August 2020, same thing. So, again, given the extent of the run, betting on the normal seasonal pattern to kind of play out to me makes a ton of sense. Assuming that that July peak was probably a significant one, I don't have a problem with that. And until the market shows you enough accumulation that tells you we're now exiting from that summer doldrums and now entering a new period of strength, I'm inclined to more, be leaning to the bearish side and be more cautious, and bet on this still just being a volatile period that is unclear.
Okay, really great looks and explanations for this, David. The bonds have been on a tear, yields have been dropping significantly. Do you have any upside targets in TLT?
Ooh, I was gonna say, I thought you were gonna say in the 10 year, and I was like, well,
All
actually,
right,
actually, Dale, I don't think so.
all right.
Um, No, no, it's true. I mean, I think the reality is, and one of the ratios I like to look at is just the stock to bond ratio, right? The SPY to the TLT. You're using
That's
two
come in quite
ETFs
a
to
bit.
just look at the relative performance of two, key asset classes. That ratio has favored stocks for years and years. It's
Okay.
actually been very rare that bonds have had any sort of strong relative performance until the last month when bonds have actually been outperforming stocks quite a bit. So while stocks, I would argue, are now clearly in a primary downtrend of lower highs and lower lows, bond prices the opposite. And so we're back to sort of that, what we assume is kind of the traditional pattern where
Yeah,
stocks and bonds move inversely. And when
right.
stocks take a breather, bonds all of a sudden emerge as a great place to be. That actually hasn't been the case for a while, right? Stocks sell off
Years.
and bonds have sold off as well, and rates have gone up. And so, the relative safety of bonds has not particularly been there. But I
Yeah,
think
it's
it's
just
it's
been another risk asset instead of
absolutely right, and it's traded
a
like a
haven.
risk asset.
Yeah.
Um,
So
and
things
and I
have
think you could
changed.
argue in some ways gold did kind of the same thing, right? Gold didn't feel like a safe haven. It was kind of rallying when stocks rallying at one point. Now all of a sudden though, you have gold testing all-time highs, you have bonds actually appreciating. So those traditional safe havens, defensive sectors like utilities and
Yeah,
REITs, I would bucket sort of the bond proxies in the
right.
equity space. All of those are actually looking quite strong here in primary uptrends. And so I think that is a notable when you think about
That's a
what do I
risk
see
off
for stocks? I think
portfolio. Risk off
for sure. I was going to
portfolio.
say that when you think about what those other charts are doing relative to stocks, it certainly seems like if you own stocks here, you're owning not the best charts out of that bucket of name. I mean, I think that's probably the weakest of the ones we've just mentioned. So I'm inclined to think bonds and particularly bond proxies like utilities make a lot of sense here. Gold as well. We've talked about gold before, and I continue to think that's from a technical perspective, it's in a primary uptrend and it looks good. And so owning
Do you
things
like
that are
any of
going
the
up at a
miners,
time when
Dave?
stocks are going down has usually been a pretty good bet.
Do you like any of the miners besides the physical gold market?
Well, I was going to say there are a number of ways you can kind of play the gold space. I personally I own GLD and accounts that I manage, and I don't think something like the GDX is a bad play here as well.
Okay. All right.
What's interesting about gold miners is it reminds you that we often think that whatever's happening with the S&P and the Nasdaq that all stocks kind of look that way. And in some market phases, that's actually been true, right? Where sort of everything looks kind of like the S&P, particularly in a big bull phase. But what now is one of those kind of weird counterintuitive things where the S&P and the Nasdaq have come down, but again, it's the Magnificent Seven kind of names that have really led the way lower. There are a lot of stocks actually making new highs. Gold miners are, it's a good chart, right? It's sort of in a primary uptrend and kind of breaking out of this basing pattern that we experienced earlier in this year, from 2023, and now, above two upward sloping moving averages. A lot of charts kind of look like that. It's just not in the areas of the market that we've thought should probably look like that. Sort of the growthy leadership names that we've
Yeah.
followed for a while. It's other areas of the market that are looking strong. I think gold miners are a really good way to play that space here.
And how about the oils with there being the potential for supply shocks out of the Middle
Well,
East?
so one, I mean, if you look at the commodity space, crude oil has kind of been certainly an outlier. I mean,
Yeah,
compared to precious
laggard.
metals.
Yeah,
If you look at, generally the trend in crude oil has been at best sideways. I mean,
yeah,
and at
yeah,
worst, probably worse than that. For me, and I often get asked because I focus a lot on stocks and ETFs. I often get asked about energy stocks because they've been, kind of laggards. They've been chopping around. The question is when, should we be layering in? And my general thought is, energy stocks are tied to the price of crude oil. So if you're buying energy stocks or you're betting on oil prices going up, the fact that oil prices have not gone up to, by any meaningful degree, given the uncertainty and instability in oil producing regions of the world, I think is a big surprise to me. I would have assumed that it would be doing a lot better than it is. And crude above $80 a barrel, I think unlocks the potential for something like energy stocks to outperform. But below there, it's
right.
just not it's not the place where oil companies tend to be making as much money and tend to be as profitable, and the charts tend to look as good. So we're really close here, and in the last week we've spiked kind of right up to that level. I have a horizontal line right at $80 a barrel to track it.
Yeah,
We get a little bit above there, and I think all of a sudden it's a compelling place. But when you
yeah.
look at the commodity
83.
space again, other
Yeah,
areas stronger.
yeah, yeah. 83 would be a breakout from the two prior highs.
That's exactly right, and so I think getting above and breaking out of this pattern would be good. Again, it's a sideways, it's a choppy, sloppy sideways trend at
Yeah,
this point. So from a technical perspective, it's sideways at best, and so it's again charts that are sideways at a time when others are clearly trending up or clearly trending down, and you have a bet to make. I'd rather go with those.
yeah. I'm certainly advising against shorting it, even though I can make a case for 60, because one
Mhm.
day you could come in and it could be in your face if anything happens in the
Yeah.
Gulf. David, your stuff is clean. Your yeah, I mean your explanation of everything. I learn every time you're here. I have a couple of things that um, I can pick up and add to my narratives. I think people should include you in their intelligence gathering. So I know you do a few different things. Where are the best places for people to follow your work and
No, I
get
appreciate
involved
it,
with
Dale. It's
you?
always a pleasure to chat with you. Look forward
Yeah,
to doing it again here. As one of my former analysts at Fidelity used to say that charts are the truth serum for the markets. So if you're looking
I
to
like it.
cut through the noise and the speculation and the narratives and focus on the evidence the market provides back to you, I'd certainly welcome people looking up me and my work. My website's called marketmisbehavior.com, and that is addressing our own misbehavior as investors, where we often make poor decisions, and let's give ourselves some tools and resources to make better ones. And then I'm on X at DKellerCMT, so give me a follow there, and look forward to engaging with your crew.
Okay, and catch David. You're still doing the final bar?
The Final Bar Market Recap Show every day after the close on Stock Charts TV. You can find us on YouTube.
Okay. Follow David. Strong recommendation. Follow this guy, and he'll keep you straight. And he keeps his emotions out of it and his biases, and he has the discipline to explain what he sees, not what he feels. Okay. So thanks, David. Great getting together with you. Always is. Want to thank you all the years you've come in and shared your great work with us. And you and I will be talking around the election.
Sounds good.
So,
I'll look forward to it. Should be plenty to talk about, Dale.
yeah, I'm sure we'll have a lot of lines to draw.
All right. Have a good rest of
Uh,
your summer. Thanks, Dale.
all right, Dave Keller, everyone. Hope you enjoyed it. It's on video. You could always go ahead and check it out. You're welcome, guys. David's here. People are thanking you. If not, what a great guy and a smart guy. Does a lot of work, not a lazy guy to do all that technical work. You have to, you know, spend a lot of time doing it. Yeah, you like him, George? All right, so the team's available in 15 minutes on the Morning Edge. Good luck to you guys today. All right, and we'll see you tomorrow. Don't just count your pips, count your blessings. You're welcome, Victor, Sinatra, Patrick.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.